for a life after work. Thank you, and I'll go straight to my presentation. We'll look at a few things. There will be a bit of introduction. How do pension schemes work? What is their governance and benefit structure? How do you access your pensions? Why do you need to nominate your beneficiaries? Why do you need to do additional voluntary contribution? We'll talk about taxation and slightly about the road to retirement and the options that you have therein. So just a snapshot of how the industry has been behaving. At the moment, the industry is the pensions industry is around 1.4 trillion, and that 1.4 trillion, that is what we have, we have over 1,300 pension schemes. There are over 6,000 trustees. In 2021, we had about 24 managers, 11 custodians, and 31 administrators. At the moment, there are about 3.2 million members in the industry. And that tells you that it's a quick growing industry. We are contributing greatly into the GDP of this country as an industry, and as such, that should give us a reason to believe that there are things that we must do right, so that then to Elizabeth, you can hear me?
Now I can. We had lost you for a bit.
Okay, sorry for that. I have stable internet. Okay. Yeah, I'm clear. Is it? Just confirm again, sorry.
Yes, you are. You are clear.
Okay. Thank you, Elizabeth. So if I proceed, that's how the
Davis, we've lost you again.
this snapshot looks like.
Davis, please repeat what you had said before. We had lost you.
The public service state schemes, just like NSSF, we have public service schemes. Those are by a board of trustees. We will be able to see that in a few. And then we have umbrella schemes. These are just occupational schemes. But
Davis,
which occupational
Davis,
schemes?
Yes. Hello, Davis. Sorry for catching you short, but we lost you before in the previous slide.
Okay.
Yeah.
Okay. Do you want me to go slightly back?
Yes, please. Thank you.
Okay. Just for clarity, I was just giving a snapshot of how the industry looks like. We have about 1,300 schemes in the industry, which have about 3.2 million members. We have over 6,000 members who manage these schemes. There are service providers in the industry. About 24 of whom are investment managers, 11 are custodian, who are banks, and administrators, where we as Octagon are one of the administrators in this market. We are actually the best administrator in this market for that fact. We have grown into 1.4 trillion. That is what I was trying to clarify. 1.4 trillion, that tells you that we are competing fairly very well with the GDP. So that means in the next few years, if all factors are kept constant and that the industry keeps growing, pension schemes are not something that you can just write off. I went further to say that we have different types of schemes. We have state schemes, public service schemes. State schemes, I gave an example of NSSF. I'm sure all of us know what is NSSF. Those who might not be aware is that we contribute 200 shillings. Your employer also contributes 200 shillings. And that becomes a saving for you for retirement. But all of you agree that 200 shillings per month, and even if it is 400 shillings, including the employer's portion, times 12 months, it's 4,800 shillings. Times 10 years is 48,000 shillings. Times 20 years is 96,000. Times 30 years, it will be barely, even if you include interest, it will be rarely be above 160,000. Or let's say, to be very aggressive, it will be very difficult to find that money getting to 200,000. All of us here in this meeting know that 200,000 is extremely very little money with this tough economic situation that we are living in. That said, ladies and gentlemen, something to mention. So we have umbrella schemes, which I said these are small. This is a big scheme that accommodates smaller organizations that want to set up a scheme, and they accommodate. They accommodate other small organizations. Umbrella schemes is like small organizations who want to set up a scheme, but they can't because starting a scheme is not very easy. So they are allowed by law to join another scheme and contribute while there. Lastly, there is personal pension scheme. And these personal pension schemes, the way they operate is that you contribute, you send in your contribution, and that contribution is what per month or per quarter is a bit flexible, is what determines what you will have at the end of the day, or what you will take home. So they are a bit flexible, and they can be used to as a good savings plan. You can transfer money if you are a deferred member in your current scheme. You can transfer money there. They make your work easier. It's important to say, just like you have a cloth design, we have different designs of schemes. Even if they are occupational umbrella, they are different designs. So you can have either a defined contribution scheme or a defined benefit scheme. Defined contribution scheme basically means that your contributions are defined or are already known. So for example, the employer contributes 10%, the employee contributes 10%, employer contributes 20%. That's just an example. So we have that. For defined benefit scheme, the contribution is not necessarily known. What is very clearly known is actually the benefit that you'll get at the end of the day, of which is dependent on a formula, an actuarial formula, which is multiplied by the number of years worked and your salary, your last salary. So that will determine how much you will take home. So we have further, for a scheme, it can either be a pension scheme or a provident fund. Ladies and gentlemen, at this point, it is important to know that for a provident fund, when you get to retirement, for a pension scheme, or for provident fund, you are paid a lump sum. You take home. If it's 10 million, if it is whatever amount it is, you are given that lump sum money, you take home. That is a provident fund. But for a pension scheme, the law allows that you can only be paid a lump sum amount as a third. 2/3 you must purchase what we call a monthly pension, which can be either an annuity or an income drawdown fund. I'll take us through how annuities work and how drawdown funds work in my slides ahead. I've said this, for staff provident funds, retirement benefits are paid to you as lump sum when you retire from service of the sponsor. Staff pension scheme, you are only paid thirds. 2/3 you must purchase a monthly pension, which is an annuity or an income drawdown fund. Why save for retirement? I don't know whether anyone can see my slides, but look here. This gentleman has refused to leave the office, so he has to be pulled from his desk because his time has come for retirement, yet he doesn't want to move. So he's told everyone has to retire sometime. I don't know whether you want to get here. I honestly, I'm of the school of thought that you can if you have prepared yourself properly, there will always be there'll always be a reason why you should be able to leave employment. And you don't have to extend, you don't have to ask for an extra contract, an extra 1 month. So we must be able to appreciate that. We must prepare ourselves early enough. We must save enough so that when it comes to retirement, we don't stay alone. There are 4 ages of pension on my slide. You can see this gentleman who is 25 years, who has just left college and gotten his first job. He thinks he's too young to think of pension. The beautiful lady on the screen, she says she's 35 years. She'll think about pension when she hits 35. When she gets to 35, 45, she forgets about it. She comes to remember at 55 when she only has 5 years to retire. She says, I should have started 20 years ago. Then there is this Muse who is completely frustrated because he wish he started when he got his first job, yet he's 75. There is little he can do at the moment. What is your age? It's not too late to start thinking about pension. And when I talk about this, I'm supposed to invoke a thought in your mind that is your money enough? What you are saving currently, is it enough to purchase you a proper pension when you retire? Research that was done by Term Benefits Authority and the industry players shows that for you to live comfortably, you must be able to afford a monthly pension, which is equivalent to 70% of your last salary. Anything between 60 to 70% of your last salary for you to live comfortably as a retiree. If you are earning 100,000, you need at least 60,000 per month when you retire. What you are currently saving can be able to purchase you a monthly pension that is about 60% or 70% of your last salary? Can it? Why do employers provide for retirement? Number one, of course, is to maintain your standard of living in retirement. They want to ensure that if you are having some food, you continue having some decent lifestyle even when you retire. Saving culture. Unfortunately for us as a country, we have to be forced to start saving. So pension is a very good investment or savings platform, which helps us to put some savings. Tax advantages. I will mention this, that when pensions savings is the only platform that is highly exempted from taxes. How does that happen? Remember, every month when you contribute to a pension scheme, any amount you contribute up to 20,000 shillings per month is tax-free. So in short, if you are earning 100,000, the 20,000 is removed and sent to your pension scheme. 80,000 is what pay is calculated on. Unfortunately, for those who are not on pension, they will be taxed. The tax is calculated on the full pay, unlike those ones who are on pension. And I'll also show you how, when you retire, how there is tax advantage. Because if anything above 25,000 is, of course, taxed at payroll. And that is what you contribute per month. Anything above 20,000 is taxed at payroll. But when you will be accessing the same, is not taxed. So it's important to know all those differences so that when you are seeing your statement or your computation worksheet, you are able to remember that Davis said about this some time back. Check here. Somebody without money, when you in old age, you will it's even easy to almost notice somebody who is suffering with problems with money in the retirement. Money has a way it makes people look decent. Money has a way it solves people's problems. As much as we say money is root of all evil, we'll also have to, all of us agree, money solves all the problems we have. Almost all of them. When you look at your life and you look at your problems, almost all the problems point to money. If you have money in retirement, you'll be able to solve so many problems, including living longer in old age. If you don't have money, it will be difficult to even pay for your medical bills, to even afford food, to even afford good shelter, to afford dealing with your problems. So it's important to have money. Mortgage guarantees, and this is two-way. Now you are allowed as an employee or as a member of a pension scheme, number one, either to guarantee a mortgage that you are looking to have by 60% of the benefits you have, or number two, access up to 40% of the money you have in your pension scheme to purchase a house. Remember, the underlying word is to purchase a house, not to build a house. That is what the law provides. You can only remove that 40% to purchase a house. Of course, the 40% is capped at a maximum of 7 million of your benefits. Fallback on job loss. You will notice that if you lose your job and you are below age 50, the law allows that you can be paid 50% of your benefits, which allows you to have something as you settle and get a job. Why do you need a scheme? One is to insure yourself against old age. Number two, ill health. Of course, number three, death. When you die, your family will at least be left with something to keep remembering you about. And unfortunately, when you leave them with nothing, I don't know how long they'll keep remembering you, but when you have money, people will always remember that this guy always helped solve some of our problems. As a member of a pension scheme, you have a few rights and obligations. I'll want to mention just but a few. Number one is that you have right to choose how your benefits are treated upon exit. Receive benefits within 30 days of exit. You cannot assign your benefits cannot be assigned, for example, to pay a loan, to meet, maybe you lost money in the company. No one can use your pension money to force you to pay obligations. It's only the money has to be paid to you. Once it's paid to you, it's you to decide what to do with that money. You have a right to choose to nominate beneficiaries. You have a right to participate in election of trustees who are member elected. Remember, in a pension scheme, we have member elected trustees. We have sponsor nominated trustees. You are also invited to and attend AGMs and receive a benefit statement. For us, those who are members of Octagon, who we serve you as our administrator, you understand that this you can always be able to access online through member portal, which we give you credentials, which you can be able to log in and get all details. Something else to mention is that, of course, the benefit structure. Those who can be able to see my slide, we have at the top there, we have board of trustees. Then we have trustees. That's board of trustees. The board of trustees cannot do all the work alone. They have service providers. They have a custodian. They have a fund manager. They have administrator, auditor, actuary, members. So board of trustees, they are the ones in charge of affairs of a scheme. They are the legal owners of the scheme. Let me say that. They are the legal owners of the scheme. Since this is not their day-to-day work and they can't be able to do all the work, putting in mind they are also employed to do other duties, they bring in service providers. One of them is administrator to help them in record keeping, compliance, secretarial work, and all that. There comes in an administrator. And then custodian to receive monthly pensions. Custodian is generally a regulated bank. Sorry for the background noise. Custodian is a bank. Then fund manager, this is an investment consultant who invests the money on behalf of trustees and to ensure that the scheme earns a return. Please go and check your statement. Does it have a return? What is the interest you earned last year? Ask your trustees, what interest are you earning this year? Yeah. Auditors, actually, these are other service providers. Members, of course, these are the actual owners who have put their money in the scheme. Schemes have different retirement structure. Of course, an employer contributes something, an employee contributes something. There is something called voluntary contributions. I'll take us through that. And I'll show you how that additional voluntary contribution, but something to mention, since all of you are coming from different organizations, retirement age is dependent on the organization. There are those organizations that recognize 55 as the retirement age, 65, 75 for some category of staff. But important to say is that early retirement by practice and by industry practice, early retirement and by provision of law, early retirement means 50 years. So means when you get to 50 years, you can tell your employer, hey, my employer, I want to go home and rest. Please approve my early retirement request, and you will be paid all your pensions money. Not all, if it's a pension scheme, of course, you'll be paid two-thirds to purchase a monthly pension, and a third will be paid to you as a lump sum. This is how your pension benefits look like. This is for a member called XYZ, who is currently aged 59 years. So there is employee portion, there is additional voluntary contribution, and there is employer portion. So that is how your statement is categorized. There is tax exempt, non-tax exempt. Tax exempt means that contribution up to 20,000 shillings per month that I spoke about. That contribution up to 20,000 shillings per month is what is captured as tax exempt. Anything above 20,000 that is contributed to a pension scheme, it comes in as non-tax exempt because it is being taxed at source. That happens to AVC and of course employer's portion. Of course, your monthly, if you've never seen your statement, please send us your request. We'll be able to send you your statement if we are your current service provider. How do you access your pension benefits? Number one is exit. You must resign. Okay, let me say this before maybe I talk about these forms of exits. Is this pension money? This pension money is actually meant for your retirement. It's not money that you should be accessing, yet you are below, you are not at retirement age. It is money that you should preserve and keep it until you retire. But because we understand the law allows that if you exit, of course, either through resignation, dismissal, or any type of exit, the law allows you can access up to 50%. If it is early retirement for a pension scheme, I said only a third as lump sum, 2/3 as a pension. If it's a provident fund, I said you can be paid the full amount. Ill health benefits, that is payable subject to approval and submission of a medical report on the basis of mental or physical disability. Immigration, that is if you are moving or you are relocating permanently from this country, the law allows you to be paid. You can also transfer your benefits to another scheme if you stopped working with your current organization. And of course, you can also transfer this money to Octagon Personal Pension if you are a deferred benefit. Under Octagon Personal Pension Scheme, you can even be able to continue contributing so that you grow your pot even as you approach retirement. Benefits claim procedure. Benefits claim procedure is, of course, when you get to retirement, you send your request to your HR. HR, of course, will contact the administrator. The administrator will generate computation worksheet. You'll have trustees approve that. Once trustees have approved that, then you are able, the administrator starts to process and sends to the fund manager and custodian to pay. It's a process that the law provides that must be paid within 30 days. As Octagon, we usually pay these within 14 working days. So I'm sure those of us who have been our members understand that. I am pausing just to see in case you have a reaction, you can check. It is important to know this process so that you don't just resign today and tell Davis, I want my money tomorrow. It's not possible. It is a process that has to be followed, and by law, it's provided by law because in pension schemes, everything is segregated to the point that you cannot be able to, one person can't do everything because of checks and balances. Nomination of beneficiaries, I'll say this and again, please note that it is important to nominate and update your nomination of beneficiary form because you never know the day when you will die. And when you die, you don't want to give trustees a lot of problems to start looking for or to start dealing with your succession issues in your family. Please state clearly who you want to be paid your money, at what percentage. Yes, so that when retirees, trustees make that decision, it becomes an easy decision. Additional voluntary contribution, of course, I said the more you contribute to a pension scheme, the more tax relief you get, up to 20,000. So please ensure you utilize that. Priority is given to contributions done by employees. So you have that leeway to make advantage of that. For AVC, you qualify for that tax relief. It helps boost your retirement income. You can transfer your additional voluntary contribution plan to a new employer in case you move jobs. And of course, you can vary, you can stop at any time. Additional voluntary contribution. Why am I saying about additional voluntary contribution? It's because I know it means a lot. Look at an example on my screen. If you are watching my screen, this is somebody contributing 2,000 shillings per month and increasing that by 10% every year. So this person, after 5 years, assuming the scheme gives him an average return of 10%, after 5 years, he will have 193,000. If he's in the scheme for 20 years, contributing the same amount of money and increasing by 10%, he will be at 3.2 million. If he's at He says he continues to do this for 30 years. That will be almost 13 million that you will have contributed to our pension scheme. So please, ladies and gentlemen, additional voluntary contribution makes a lot of change. It improves how much money you'll get at the end of the day. I'm sure all of us want to get that 16.8 million there. And you can improve that. And this, you have not included that your employer contributes something else is deducted from your salary, which is not necessarily additional voluntary contribution. You retire a very peaceful man. Let me tell you, 16 million can pay you a monthly pension of about 150,000 there per month. 150,000 per month is good, and there's a lot of money that can help you in retirement. Our pension contributions taxed. Our pension money taxed. Of course, there is level 1, there is level 2, and there's level 3. I'll take us quickly through each step. Contribution 30% of your pensionable income gives you a relief limit of 240,000 per month or 20,000 per month. I've already spoken about this in terms of contributions. In terms of investment income, I talked about tax exempt and non-tax exempt. So for the tax exempt, the income that comes to investments on money for tax exempt is also not taxed. However, income in respect of any amount that is above 20,000, it is taxed again. But that is the money, remember I said, even if it is taxed again, when you will be accessing, you are not taxed. But the money that was not taxed at source, the income was not taxed, now it's taxed at some point. How is it taxed? That is now on level 2. You are given a relief of 60,000. That is now when you'll be accessing your pension money. You are really given a relief of 60,000 annually, subject to a maximum of 10 years. Below 50 years or less than 15 years in the scheme, benefits are subject to lower tax band. So you are highly encouraged not to access your pension money if you are less than 50 years. Because it is punitive, you pay too much tax to the government, which you could easily save and use that money for your retirement. About 50 years or more than 15 years in the scheme, benefits are subject to higher tax bands, which means you pay lesser tax. Of course, I said this one, the non-tax exempt that was already taxed, it's not taxed when you are accessing a retirement. Something to mention is any pension money you earn, which is up to 25,000 shillings per month, is tax-free. And when you are at 65 and above, anything you get as monthly pension is tax-free. Let me give an example. For those I said who are below 50 years and or have been in a scheme for less than 15 years, it is punitive to access your money. Please don't access your money if you are below 50 years. I will highly encourage you. In any case, you can leave the money in the scheme to continue earning interest there, or you transfer to a personal pension scheme and continue investing there, or transfer to your current scheme. I'll show you an example of how this money is accessed. Let's look at an example of somebody who is getting a lump sum of 3 million. If you're getting 3 million and you have been in the scheme, say you are 50 years and above, or you've been in the scheme for more than 15 years, the first 600,000 you are given tax-free. So the taxable amount is 2.4 million. These are the 2.4 million is taxed. The first 400,000, 10%. The next 400, 15%, 20%, 25%, and whatever remains, that is what you will pay at 30%. So you end up paying a tax of 520,000, you go home with 2.48 million. This is a lot of tax, if you ask me, ladies and gentlemen. And I will tell you, somebody is saying that I'm rushing. I'll try to go slow, but I have I have quite some content to cover. Feel free to drop a message where you think it is not clear. I'll be able to clarify. Understand I'm going very fast, so sorry for that, but then I have very few options. Something to mention is so this 520,000 you have lost as tax. For me, is a lot of money. If you leave this money or convert it into a monthly pension, it will pay you let's say this 3 million. If you convert it to a monthly pension, it will give you about 25 to 30,000 shillings per month, which money you are highly likely to get it as a tax-free amount up to 25,000 shillings per month. And that 5,000, the tax on 5,000 is too little to be noticed, instead of losing 520,000 in this arrangement. So my encouragement is always, when you are accessing your pension money, please talk to us as your administrator. We will advise you on how to save on tax, not necessarily how to avoid paying tax, because tax avoidance is illegal in this country, but we are able to advise you how you can take advantage and don't pay too much tax, because the government or the Income Tax Act has allowed you to do that. Another example here is 1 million. This person who is being paid 1 million, he has been in the scheme for 20 years, is now age 52. Of course, the first thing is he gets a tax relief of 600,000, and it remains with 400,000. The 400,000 is the only amount that will be taxed at 10%, which you will end up paying 40,000 shillings, and you will go home with 960,000. Go home with 960,000. Case number 2, this is somebody who has been in the scheme for more than 5 years. This is actually 5 years, and he has 1 million. Age is 35. The tax is more, so that means he will take a net home of 1,852,000, which is he ends up paying more tax than someone who is older in the scheme. So please do your mathematics correctly. Always talk to us. We can advise you how to deal with this problem of paying too much tax. Annual member statements, I think I've spoken about it. There is employee portion, employer's portion, additional voluntary contribution. Please check that your statement conforms to that. There's something called income replacement ratio. I know all of us could all of us could ask ourselves, what is income replacement ratio? I have just spoken about it. Income replacement ratio is what I was speaking about. How will you be able to replace your income at retirement? How are you able to replace? So that is what I said, that income replacement, you must ensure that you have at least 60%. That is according to international global standards on social security, which recommend at least an IRR of 60%. So as I asked you, I told you anything between 60 to 70%, you are safe. Please ensure that your monthly pension, if you don't think you are sure, please reach out to us. We can look at your statement, we can look at your age, we can look at any actual factors, inflation and investment needs and all. We can come back and tell you why we think you are missing out on this. If you want to achieve this amount, please start doing this. This is the amount you need to start contributing. We do that advisory service as a business, which helps you to ensure that you have enough money in the pension scheme. Retirement access options. This is how the modes of access of money in a pension scheme. You can use a pension or use a drawdown. A monthly pension, which is a lifetime annuity, we get you a quote from an insurance company. As Octagon, now that we have access to your data, when you approach retirement, we get you a quote. This quote helps you to make a decision which type of annuity you should go to. We also negotiate for you the quote so that you have a fairer quote compared to you going directly to the insurance company. Highly likely you are not an expert, so that is where we come in to assist you. Or number 2, if your scheme offers a monthly pension, they can do that. So what happens with annuities? I can take us through that. So it's happening in a few. So we have annuity, we have drawdown. So drawdown, I'll take us through this. So allow me to skip that slide because I have explanation on that. Options you have in retirement, of course, I've talking about lump sum, annuity, income, drawdown. What I have not talked about is post-retirement medical cover. Which way for a retiree? Of course, on mortgage, I've already spoken about it. Option 1, use it as collateral security for your mortgage up to 60%. Option 2, access part of the benefits to purchase a residential house, which is 40% of your pension, subject to a maximum of 7 million. You can add AVC. You can also add any other money you have from other schemes to get to that 7 million. Yeah, you can access joint benefits with spouse, of course, per scheme rules. So reach out to your scheme and find out from your trustees what they have done about the mortgage policy, just in case you want to access this to purchase a house. Payment of lump sum, of course, on attaining 60 years. I said if you are in a provident fund, you are allowed to access this. Though, ladies and gentlemen, I don't know whether I've said, maybe I haven't said, is the disadvantages of taking cash lump sum is that you are highly taxed. That's why I said, please always talk to us to advise you how to deal with that issue of tax. You might also fall victim into scams on investments. Some of us think that we are good investment people, yet we are not. So you end up taking money to wrong. You go buy a matatu, for example, the matatu gets an accident, you hadn't insured, the matatu collapses with all your retirement money. So we always advise you, please, before you make a decision on how to deal with your money, please talk to experts. Don't talk to people who teach you about gambling and everything else, which makes you to gamble with your investment money. It is not the right time to start gambling. This is money you have saved for the last 20, 30 years. Please don't lose it in one day. Don't lose it in one day. Intended use of benefits retirement, you will end up not achieving that because you have already accessed money. You would rather you get, instead of getting a 3 million as a lump sum, you rather get that 25,000 shillings per month. But then this 25,000 shillings is for the rest of your life, because there are high chances you might probably live for 20, 30 years after retirement. Of course, you might also outlive the 3 million. Be sure after 3 years, that money might never be seen, or you might not have gotten. Some of us think that we can go and do rental houses. Oh, and when you do those rental houses, you start earning a rental income. But the thing you must ask yourself, what percentage of rental income will it bring the investment that I've done every year? So if I've given 10 million, will the rent that I get from there be at least 100,000 or 250,000 shillings per year, which gives me a return of 15%? If it doesn't, then you are wasting your money. You better have that money in a pension scheme. I know this is controversial. Most of you you love to deal with property and all that. I might look like I'm irrelevant, but then please always find out. Research has shown that property in the market currently is not giving optimum yields. So always find out from your investment expert what to do. And that service we also offer free. What has research shown is that very few retirees live comfortably. In fact, that 1% of them actually live comfortably, but 47% end up dependent on relatives, and then 16% are dependent on pension, and 6% are the only ones who are financially independent. Where are you? Where are you in this graph? Where are you in this graph? In terms of businesses, 48% of businesses started by retirees, 48% is unprofitable, 21% of such collapsed, only 31% is operating on profitability. Cash lump sum, I think I've already explained this. I'll skip this slide. It's a repetition. What is an annuity? What is an annuity? Is a specified income payable at stated intervals for a fixed period or a contingent period. Forget about the English. An annuity is a monthly pension that is paid to you. So you are paid for life. If you give an insurance company, say 5 million, they tell you they'll be paying 50,000 per month. They do that for the rest of your life as long as you live. Even if after retirement you live for 50, 60 years, they'll continue paying you. That is the good thing about an annuity. That is why I was telling you guys, even if you're in a provident fund, please always put some money. You don't have to take the whole money. If it is 5 million, 3 million, purchase a monthly pension, 2 million, go blow it up with what you want to blow it up. But you can take maybe 4 million, purchase a monthly pension. I know of provident funds or members of provident funds of some schemes who have made a decision that is, as much as we are in a provident fund, for us we'll purchase a monthly pension. You can also do that. So the insurance company does a quote and tells you how much they'll pay you. It depends which insurance company. Payments are made monthly or quarterly or semi-annually. Once an annuity is in payment, it cannot rescind. That's the unfortunate bit, is for an annuity, once you give in your money and they start paying you per month, you'll never rescind that decision. That is the only unfortunate bit. But the advantages of you purchasing an annuity exceed the possibility of you wanting to have to recover your money from them, because you have a lifetime agreement with them, which they must honor. Annuities can be in constant level. You can choose escalating, non-escalating. They can increase, of course, at a certain percentage or not increase. Number two, and this is the most important thing that I say about annuities, your annuity can be guaranteed or not guaranteed. So what does that mean? When you purchase an annuity, and you die mid-term, your annuity payment stops. So to cure that, because you probably have children who are dependent on you, to cure that, insurance companies, the Act brought in something called guaranteeing an annuity. So you can guarantee an annuity for 20 years, 15 years, 10 years, 5 years. And when you do that, even if you die mid-term, if you take a guarantee annuity for 20 years, and you die on the 13th year or the 15th year, your family will continue being paid for the remainder of the period. So please check out that you always purchase a guaranteed annuity. I will advise you for free, ladies and gentlemen, please always ensure you take the maximum guarantee period. Don't settle for less, because you might live longer than you expect. Of course, if you live more than 20 years and the guarantee period has ended, immediately you die, also the annuity stops. But then 20 years, you could have already recovered the principal amount you put there, plus any income, and you could have actually been overpaid if we help you calculate. These mathematics, you can always help you to come up with. This is an annuity quote illustration. This is somebody's buying 1 million. The insurance company, if it is male, they'll pay about 10,000. They'll pay about 10,000. For female, it's about 9,000. The difference is that women tend to live longer than men. The mortality rate for men is higher. I don't know why. Maybe we need to find out why do men die earlier than women. So guaranteed for 10 years and life thereafter. Of course, that's just an illustration. When you want a quote, we will give you a quote. Just check how old are you right now. Tell me, Davis, can I get a quote? Can we come and sit down and discuss this? We will be very much willing to help you discuss this and get you the best out of it. Process of annuity purchase. You agree to pay annuitant or purchaser. Of course, you get a quote. You pay to purchase that annuity. The life office agrees to pay annuity in installments every month, quarterly, or the way you want that. You can also take an immediate annuity or a deferred annuity. And of course, you can take a joint life last survivor annuity. So that in case you die, then your spouse gets to be paid thereafter. Characteristics of annuity can be either increasing or decreasing. Enjoy a tax relief of up to 25,000 per month. That is if you are below 65 years. After 65 years, of course, you are not paying any tax. Annuity example, this is for 1.6 million for just an example of a scheme. Just the same, not so much difference. For lump sum, I told us, please ensure that we avoid this lump sum approach. I will sing this and again. Please ensure that you don't do this. But if you have fixed, you have to access the lump sum, please always talk to us. We tell you how to save on taxes. Number two, you might say, me, I don't want an annuity. I want some bit of flexibility. I think annuity confines me too much. Davis, do you have do you have anything flexible? Now, that is where something called income drawdown comes in. Income drawdown, you take the same amount of money there, or whichever the amount you want to put there. The law allows that you are locked for only 10 years. So if you live at 60, you are only locked up to age 70. There, you are allowed to access up to 15% every year of the money you have put there, or the running balance, up to 15% of that. So that 15%, sometimes it's because your money is also being invested. Sometimes you don't get to access the whole 15%. Probably that is interest that you are accessing, or part of interest, or slightly a small amount of the principal. So that allows you to be able to save some money and have some money remaining with you. After 10 years, you remain with a residual amount. That residual amount, you decide whether you should keep it for another 10 years in the income drawdown, or purchase a monthly annuity, or purchase what we call or take home as lump sum. So RBA rules provide for a minimum drawdown period of 10 years. I hope that is very clear. In case you are not clear, please always tell me. The only disadvantage is that income is not guaranteed, has flexibility as regards to investment choice, frequency, timing, and amount of income withdrawals. In selecting an income drawdown, members assume the investment or longevity risk. Of course, that is the only challenge. For the insurance company, they promise you 25,000 per month for life. But for the annuity, if the interest or the investment income in the subsequent year is lower, it reduces the amount expected. So your pension might be reducing as we go. What I usually advise people, if you think the decision to make whether you are going for an annuity or income drawdown is dependent on how how do you perceive risk? Are you risk averse or not? If you don't know where you are in terms of risk, then put some money for annuity, some bit of money, purchase a drawdown. Yeah, of course, payment will continue until fund is exhausted or you finish the period that you are supposed to be in that scheme. I've mentioned why income drawdown, flexibility, and all that. Equally, we have Octagon Income Drawdown Fund, so that means you can be able to get a quote. We can get you a quote on how our income drawdown fund works. You compare with the annuity quote and make a decision of what you want. I think I want to, as I approach the end of my presentation, there's something called post-retirement health challenges. Post-retirement health challenges are simple. When you stop working today, your employer stops paying for your medical cover. So where are you left as a human being? Because as you approach retirement, that is when you have more challenges. That is where many sicknesses start coming in. That is when your body is susceptible to any problem and all that. Yet it is the time that you don't have a medical cover. What that means is if you get sick, you'll have to go into your own pocket. You sell your property, you go sell your asset, you use your pension money to deal with medical challenges. That has been a challenge for the Kenyan market, for the Kenyan pensioners for a long time. So a few years ago, the Retirement Benefits Authority came in with something we call a post-retirement medical savings plan or scheme, which allows you as an employee to start saving for your medical needs when you are still working. Or even if you have approached retirement, the law now allows you can put aside some 10% of your money or some portion of your money to help you deal with the medical needs. So how do you deal with that money? Instead of taking it home, you can let it remain in a scheme or transfer it to a scheme that supports post-retirement. Then every year you can be paying medical insurance from that scheme. So the money is being invested, it is being run like just a scheme, the normal scheme that you have been operating from, but all the advantage is that you are able now to access your pension money, your money to be able to deal with the medical needs. Believe me, whether you like it or not, as much as you love God and you want to say that, oh, for me, God will take care of me, God also doesn't want lazy people. God wants people who think about their needs. And the problem that you'll meet in retirement is post-retirement medical needs, which you must address when you are still of sound mind and when you are able to do that. Employees who outlive their life expectancy by at least 1%, average 66%, and by more than 10 years. That is according to Towers Watson report. There are few available medical insurance covers for the elderly, and this is where I want to mention here categorically that as Octagon, we have a post-retirement medical cover. Immediately you get to 60 or you stop working, even if you are 50 or even if you are 40, we have a cover for you. The cover doesn't have waiting period. That means when you come in, you pay for premiums today, next week you can even go for hospital for treatment. You can even take this cover for your children. You can also take the cover for your mom, for your dad, for your mother-in-law, for your father-in-law. Because you understand NHIF might not be enough to take care of medical needs. Please reach out to us. We can give you a very good medical cover. I might not have all the time to present about it in this meeting, but in case you want to reach out, please feel free. Of course, I've mentioned this. This is a scheme which allows members to contribute towards their healthcare and retirement costs after retirement, which, while still in active employment, contributions made into the scheme are invested and subsequently used to pay for inpatient and outpatient medical bills for members and their stipulated dependents. The scheme funds may also be used to pay medical insurance premiums for members if such insurance for elderly individuals is available in the market, which I've already told you we have it as Octagon. For all the clients under Octagon, we have. a cover. Retirement is not the end of life, but rather a beginning of an exciting experience. Something else to mention, and I forgot to include this slide in this meeting, probably I'll include it in the next slide, is that also when you stop working, your employer also stops giving you something we call group life assurance. These are group insurance. This is a cover that helps you in case you die of sickness while still working, or whatever type of death that may come your way. Group life assurance pays a portion of your salary for every year, maybe say up to a maximum of 8 years, to your family in case you die or you get critical illness. Immediately you stop working, unfortunately, your employer removes you from their group life assurance cover, so you are not covered. So in case you die, your family might be left destitute. We also have a product for all people above age 40 who have left schemes, and even if you have approached retirement, we can be able to give you some decent cover to take care of your group life assurance. So the cover provides up to 30% of benefit for critical illness. You can choose, say, 1 million, 2 million, 3 million, 5 million as your group life assurance cover. You pay upfront premium, which you pay one-off, is very little premium. Depends, the amount to pay depends on how old you are and whether you are male or female. And then we advise you the premium to pay, and then you pay, and we give you a policy document, and then you wait for the day which God might call you, or the day that you might get critical illness, and then you make a claim and you are paid. Retirement is not the end of life, but rather a beginning of an exciting experience. Retire happy. Make retirement the best years of your life. And of course, how resilient will you be in retirement? Please, how resilient are you? Will you still be strong? At that, this is a beautiful couple in their retirement age. This is probably a house they have, their retirement home, and life has just begun. I usually say retirement is the longest holiday that you can have. I call it the longest honeymoon that one can have. So that money you are using probably to do a wedding today, you can preserve that money and to go for honeymoon after retirement. Of course, a few other things, please ensure you plan your family well. Those are a few things that we always don't want to talk about. Plan your family well, know when to give birth so that you don't go with a toddler to retirement who will give you a lot of pressure to pay school fees. They have disciplinary cases, which increases your pressure. Learn to know which food you take. Learn to know when to exercise. Your body needs to be healthy. We don't want to have a retiree who's very rich but very sick because of lifestyle diseases. Please find out how you can manage your cholesterol, how you can manage your blood pressure, how can you manage your blood sugars, so that when you approach retirement, I know that you might not have a lot of control, but at least there is something you can do to live fairly a normal life, or something closer to a fair normal life. Road to retirement, plan. Learn how to balance your life and career. Don't overdo one and forget about the other. And of course, exercise, and please relax. Go out and socialize with people. You are a social human being. Create networks. There are some things you can do in retirement, which can include these voluntary activities, helping church people, helping the needy people in life. Those are people you can help, and is very fulfilling at retirement. Yet it can add you a day or a few hours. Understanding yourself, look yourself in the mirror. Even if you look like a cat, in the mirror, when you look at yourself, you look like a lion. Thank you, ladies and gentlemen. That brings me to the end of my presentation, and I want to give room for any questions. I am here to respond. We will be able to respond to all your questions. Asanteni sana. Thank you very much. Please feel free to, Elizabeth, over to you now.
Thank you. Thank you so much, Davis. That was very, very much insightful. I feel like personally I have learned so much, but before I continue talking, in case anyone has a question, you can raise your hand and I will be able to unmute your mic. And as we do that, I will go through the questions that were brought up in the conversation section of this meeting. If you have any other questions as well, if you don't feel comfortable enough to put your mic on, you can always type in on the comment section. So Esther Wanjiro Kinyanjui says, it's the love of money which is the root of all evil, but money itself is not evil. Very true, I agree. Evelyn Nyapara asks, when I leave my current employment, can my pension contribution continue earning the same return as it currently earns with my current employer?
A quick response. What's her name? Evelyn
Evelyn.
Nyapara. Interest is not cast on stone. Interest that is declared is dependent on the performance of the market. So your fund manager invests the money, but then even if you move money, the money is still being invested in the scheme that you are going to. So you will still continue earning interest. It's only that it might be different. Interest, even in your current scheme, you don't earn the same interest every year. It keeps changing depending on the performance of the economy. So the same way, even if you move money to another scheme.
Sarah Kano says, please elaborate on trustees for those in personal pension scheme.
For those in personal pension, thanks, Sarah, for that beautiful question. For those in personal pension scheme, okay, maybe I should have mentioned this. There are two types of trustees. They can be individual trustees or corporate trustees. For individual trustees, members elect their trustees who represent their needs and all that. But for corporate pension for schemes, and that happens for most personal pension schemes, including our very own Octagon personal pension scheme, we don't do individual trustees. We do a corporate trustee who is KCB. KCB Bank is our corporate trustee. So you might, it's difficult for us, for example, who have over 150,000 members to sit down and agree on one person who should be voted as a trustee. So instead, what we have done is to have that through a corporate trustee who is KCB Bank. And of course, the other organizations can also do that. So KCB Bank is a corporate trustee. Over to you, Liz.
Eunice Wanjiro says, if Octagon is administering for a former employer, can they assist to consolidate the employee fund?
If Octagon is administering for a former employer, yes, Eunice, we can. We can do that. We can do that, help you. So please reach out to Elizabeth. Elizabeth will be able to guide you or find you someone who can be able to assist. At the end of this meeting, we'll also share with you an email address which you can make that request so that we help you do that. We will tell you which form to fill or which documents to bring on board so that we help you in consolidating your assets. Thank you. I see there was one who was complaining that the presentation was rushed. I think we responded to that.
Yes, we did. So Nuru asks, hi Octagon, are the consulting services pro bono?
Yes, Nuru, it is completely very free. Please reach out to us. We can organize for a session with you with our experts. They can reach out and be able to advise you on what you can do.
Patrick asks, can you continue being in a scheme beyond retirement? What are the benefits or risks involved?
Patrick, I have very many ways I want to respond to that, but I have one way is it is allowed, you can continue, but only that you need to be notifying after every 2 years, oh, I am alive, so that in Unclaimed Financial Assets Authority doesn't think you died. So you have to ensure that you always update your trustee schemes that you are existing, and probably put the money in a personal pension scheme so that you continue contributing. That is allowed. No one can chase you from a scheme. As long as you are alive and it's a decision you have made, no one should be able to chase you. But please let them know very frequently that you are alive, then they don't ever make a mistake and forward money to Unclaimed Financial Assets Authority. However, why do you want to keep that money, Patrick, in a scheme? Do you want it to grow? What is your aim? I would want to listen to you and be able to probably advise you. Because if you have money that can purchase an annuity, for example, I wouldn't advise you to keep that money in a scheme because there is no advantage. It will keep growing so that you at some point you earn more interest, which is good. But then you can even transfer that money now so that the insurance company starts paying you the monthly pension right now, as well as you concentrate on other investments as well. So let's look at case by case. Patrick, reach out to us. We will be able to give you advice that is a bit more customized.
Thank you, Davis, for that. Patrick, if you have any other questions, feel free to raise your hand. We have a compliment from Eunice who says this is a good presentation, quite rich. Thank you so much, Eunice. Irene also says very insightful presentation. Please share the slides and recording. Again, I will repeat, we will upload this recording on YouTube on Monday, so all of you can kindly follow and subscribe to our YouTube page, Octagon Africa. I know the one who said the presentation is rushed. You can also go back and view it on Monday on our YouTube channel. Michael Omondi Seranga says, good presentation. Exactly how long does it take to start getting paid for the benefits? Is it immediately after retirement or a year or a month?
It's all you need to do, Michael, is it's actually immediate after those 30 days. So once the process of paying you is complete, you start being paid immediately. So let me put it this way. There is that process of being paid pension benefit. So as they being paid and money has been transferred to the insurance company, they put you in the next payroll. So if the money hits the account before 15th of the month, they'll put in the payroll for that month. If it exceeds 15th, they put you payroll for the following month. Yes.
Eunice Sonjiro also asks, does fund on annuity earn interest?
No, Eunice. What you agree with them, they'll be paying you 30,000 per month. That is what they will give you for life. So there is nothing that will increase like interest or anything.
Eva says, a very good presentation with lots of insights.
Thank you, Eva. We greatly appreciate the feedback. You can always spread the word, whichever the organization you are working in. We can always come in also to do a customized training for your employees that looks like this or even better than this. So if you think you want us to come to your organization and do a now pension clinic for your individual organization, I want to confirm that yes, we are available to do that. We only need to organize with our consultants and then they will reach out to you and plan for the day, event, and time.
Penina says, powerful presentation. Thank you.
Thank you, Penina.
This has been very awesome, Davis. I also agree. This was such an insightful presentation. We hope to have you again and again to take us through the pension clinic. For those who are here, for those who've never attended, again, I had said before that we usually do this twice in a month. So the next pension clinic for March will be on 18th, a Friday. If you have recommendations on something you would like to, know more about it, learn more about, you can feel free to reach out to me on training@octagonafrica.com. If you have any questions, any queries, any comments, that is the email. I will type it down on the comment section. Anybody who has any other question, any comment, can also feel free to type in the comment section before the meeting ends. Again, subscribe to our YouTube channel, Octagon Africa, where we upload this weekly sessions. So our email is usually training@octagonafrica.com for any queries, any questions that you may have. I would still like to hear one of your voices. So in case anyone has something, you can still raise your hand and I will unmute your mic. You can also reach out to us on info@octagonafrica.com. Davis has typed in the email. I will also type in the training@octagonafrica.com. Yes, they're there in the comment section. Please save them. We can't wait to hear from you. If you're also interested in our post-retirement medical fund, feel free to let us know on the training@octagonafrica.com and we will hook you up and let you know the process of getting that. In case there is any other question or comment, I'll just wait to see.
Maybe Liz, as we see whether there might be any last comment, I can ask you share the link of the YouTube channel, then they can subscribe. Anyone who wants to, yes. So that when we have our next upload, they are notified and then they watch.
Yeah, I acknowledge that all of you registered to join this training. So once we upload it, we will share the links with you to your emails. Also, Patrick says, kindly share a telephone number. As I type it down in the conversation section, Davis, please give us maybe the last few words. Davis, any closing remarks?
Okay, sorry, I was muted. Thank you once again, ladies and gentlemen. Thank you for sparing your time and to listen to us. We greatly appreciate your feedback. We greatly appreciate your support. And where you think we should improve, please feel free to let us know. Elizabeth has spoken about a wonderful, has talking about our next session on 18th. I request all of us who are in this meeting, please don't miss the session on 18th. We are going to talk about something to do with wills and estate planning and so many legal terms which will train for you for free. I know it is a training you will never find elsewhere. We are the only ones doing for you this training. We have a legal expert who's coming to talk about that. So please feel free. Make sure you block your calendar for 18th. We will do emails, but block your calendar. You don't have any other event. We will probably going forward try to see whether we can schedule this meeting in other times during the day. Some people are saying, giving us feedback that it's working hour. We can't be able to listen to the webinar at the same time. We'll try to consult and see which time works well. You as our client can also be able to advise you. I think this is the time that works well with us. And Elizabeth will take that and organize how to plan with it. So I thank you. I wish us the very best. Take care. COVID is still here. We pray that it gets away, but feel free to reach out in case you want a quote. As I mentioned, you can always reach out to us or any clarification. Have a good day and keep safe. Take care. Lovely weekend.
Thank you, Davis. Thank you so much, everyone, for taking your time to join us today. I hope you have learned something and you're going to take something away. I wish you a lovely weekend and see you on 18th. Thank you so much. So you can feel free to leave as you wish. Thank you.